Hey everybody, this is Amanda Davis, owner and founder of Business Solutions by Design, your accounting ally. Coming back to you, finishing up the month of February with loving your business. And part of being in love with your business is understanding all the jargon, right? Well, my jargon, every business has their own, right? When I used to work in CPA land doing taxes, we talked in acronyms all day. It must have been obnoxious to everybody else who got to hang out with us. And in the bookkeeping world, it's less so, but there are many acronyms and specialty words. In the wedding industry, I'm sure there's tons of wedding lingo that comes in. The photographer business, there's tons of specialty jargon. But I'm here to talk to you about something that actually translates across all businesses and organizations, and that is your bookkeeping and accounting numbers. So there are things that you probably need to get familiar with if you're in business and understanding your financials, right? So what are the financial reports? The basic reports that you're looking for are a profit and loss. That is income statement. They're interchangeable, profit and loss, income statement. They both kind of get across the same information. They take your total sales, your total revenue, your total income, gross. What you made, and then everything that comes out at the end of the day. If you had to purchase products and materials to create a product to sell, if you are selling services, if you have rent, if you have insurance, on and on and on. So it takes what your total sales are and it reduces it by your operating and your cost of goods sold, and it gets you your net profit, which is basically where we start in terms of discussion when it comes down to your taxes. And that directly is the first place your taxes as a small business owner is derived from, because it goes from there. Of course, there's specialty laws like meals and entertainment that's only taxed at 50%. So these are the kind of like the little jargon. So your net income really helps to determine your taxable income and how much you're going to owe in taxes at the end of the day. So it's really important. What are the other statements that you might be interested in? A balance sheet. A balance sheet is basically your ownership in the company. You can see it kind of gives a really good indicator of financial health. It shows all of your assets. Assets are things like your bank account, if you own a car, or if the business owns a car, actually. If you have anything else that could generate income that you can sell to have money, then that's an asset. If you have a home, that's an asset. If you have a car, that's an asset. These are things that you have and you physically could get money for. And some things are more liquid than others, like cash in the bank versus maybe a long-term CD or a money market that you can't touch, even a retirement that you can't get into until under certain situations or until after you reach a certain age point. So there are things that are called assets, and some are easier to access than others, and some, kind of are more longer term than others. And then on the reverse side, you have things that you owe, like credit cards. So let's say you've used a credit card in your business and you have a balance on it. That's something that if you close the business, you have to pay that credit card off. There's no ways around it, right? And so that's going to go with any type of loan. If you got capital loans for your business, anything else, if there's a loan on that automobile that the business bought, yeah, that's going to go in there. So basically the balance sheet says, hey, here's everything that you have money that you could make money on, like taking money out of your bank account, selling that automobile. And then here's everything that you would pay out. Say if you had to close down the business, your credit card, your loan, your auto loan. If you sell that car, you're probably gonna wanna pay that loan off, right? I would hope so. I can't imagine they would let you release the asset without paying off the debt. So those kind of things. And then at the end of the day, what that boils down to is the equity in the company, the ownership in your business. So it takes all of your assets, it takes all of your liabilities, it pulls in the amount of net income. We talked about that just a little twinge earlier. And then that kind of shows you whether you have positive equity or negative equity. And that's just basically your overall ownership in the business at any one time. So those are the statements that you should be looking at. You should also be looking at cash flow because cash is king. So you should be checking out like how much cash do you need to operate? When are you gonna run out of cash? Those are highly important things. There's all kinds of different metrics that are used in these financials. ROI, return on investment, that's a big one, right? Gross profit. A gross profit is, say you sell a product, say you sell t-shirts, and the money that you get from the sales of the t-shirts less what it costs you to purchase the t-shirts at wholesale, that amount is called your gross profit. And then you have your gross profit margin, which kind of tells you as a percentage how good you're doing. Like, so maybe your gross profit is, you know, $50,000, but your gross profit percentage is only 20%. That means you're only making 20% of your on your sales versus your cost. So it costs you, you know, 80% to get that sale done. That may not be awesome. It might be awesome. It just kind of depends on what it is you're working with, those kind of things. So it comes down to direct costs versus direct sales. So I hope you learned a few things here. Tell us your favorite crazy business acronyms. We'd love to hear all your jargon and how things are going. But this is Amanda Davis, owner and founder of Business Solutions by Design, your accounting ally. We'll be coming back to you next week.